Good morning and welcome to the Money Control live stream. You're watching another edition of Markets with Santo and CJ. Well, today we want to talk about the IT sector. Why? Because the IT sector, the Nifty IT, has seen around 11% rally over the past 1 month after hitting a multi-month low in mid-July. Why this rally has happened, we'll get into that. But clearly, it seems like investors are cozying up to the sector once more. And although it is tentative at this point of time, it is not gung-ho, but they are cozying up. Now, incidentally, CLSA also has today come out with a note on the sector. Now, let me just give you a little bit of a context why we have seen a revival in IT stocks. Of course, this revival is in line with what we have seen across the market. If you look at the Nifty 50 index, that has also risen about 12 to 13% from the mid-June lows. So clearly, it has been rising with the market. But I think one of the biggest factors, Santo, is the fact that the recession probabilities in the US that was running so high back in early July, they have come off quite considerably.
Have they really?
Yes, they have. I mean, people from JP Morgan to Morgan Stanley have been talking about the fact that recession probabilities have been falling fast because data is not showing that pain.
But I thought technically US was already in a recession after two consecutive quarters
according to US economists, unless the job market does not go into a recession, it will not be really fair to say that the economy is in a recession. So, I mean, there are technicalities around it, but clearly, I think investors are taking a more longer term view as far as the growth trajectory is concerned for the IT sector. Now, what CLSA has to say is that they expect that the downgrade that the sector has been seeing over the past 6 months, that may pause in the near term. And the margin issue, which was of course one of the most debatable issues over the past 6 months, that itself could improve going ahead. Now, during the June quarter earnings, you had some of the IT companies coming out and suggesting that attrition rates might have peaked. They expect that rate to continue to fall probably from the second, third quarter onwards. And along with that, of course, execution costs are coming down according to CLSA, and they believe that the combination of both of them could help margins improve in the second half of FY23 going ahead. Now, along with that, of course, Money Control, exclusively reported yesterday that Wipro has halted variable pays for mid-senior to senior level management people. Now, that basically goes to suggest that should provide some bit of comfort on the margin as far as Wipro is concerned. It will be interesting to see if other IT companies also take the cue, because defending margins, it seems, have now become very important.
Well, more than defending margin, probably I think Wipro's decision shows that it can afford not to pay out variable and still manage to retain people. In this time when there's a fight for talent across the sector, you're seeing Wipro actually go out and halt variable pay. Yeah. So that seems to be a very bold signal.
I think, Santo, it also suggests that probably the labor market within the IT sector is also changing because of the the funding crunch in the startup space. Let's not forget that startups were the biggest poachers of IT talent over the past 1.5 years. Now, since hiring there has slowed down considerably, plus they have been laying off employees, it's easier for IT companies to get new hires than it was, say, 6 months ago.
Well, a few points there. Now, the 11% jump in Nifty IT over the last 1 month, overall I think IT sector has also risen along with the rest of the market. You've seen most sectors barring one or two which has not really done well. Also, there are indications that big US banks are kind of cutting back on their tech spend. They've already said that they will do that, and according to a note by Elara, 29% of the Indian IT sector's revenues come from the BFSI vertical, and that's where you're seeing banks like Wells Fargo, Goldman Sachs and Morgan Stanley actually having come out and said that they will go in for a spending cut. In addition, many other banks, like for instance Bank of America Merrill, has said that it would look at some self-funded tech initiatives in a bid to cut costs. There are other banks talking about cost efficiencies, operating efficiencies, which basically mean that they will reduce the compensation based clause which they have with IT companies. So all these factors still indicate that it is not a given that demand will continue to be strong. If you look at the first quarter numbers also, the big concern of the market largely was, is there earnings visibility beyond FY23? FY23 seems good enough, at least there is no problem. The bigger issue is that maybe there could be some relief on the margins front. As you say, the labor market is showing signs of cooling off, but demand still remains the big thing. So if two things here, A, the market at this point is saying that there will be no recession, which we are still not very clear about, because the rate hiking cycle is yet to run its full course. So, we do not know how that will play out. Secondly, when you said that this funding crunch in the startup sector is leading to some bit of cooling off of labor market, the startup sector still accounts for a very small portion. Look at the scale of the hirings in the IT sector and the tech sector and the startup sector. So, any problem there won't make a very big difference here. At the margins, yes, it may give some relief, but not really.
I think, Santo, as far as demand is concerned, yes, maybe a lot of the operational efficiency related demand may see some bit of weakness going ahead. But I think digital transformation deals is something that where the outlook still remains quite robust. If you look at the commentary that came across from, you talk about TCS, you talk about Infosys, they all were quite buoyant by the fact that digital transformation deals, which of course is cloud transformation and whatnot, which actually has been the focus of the IT space, that they don't expect to be affected by any sort of slowdown in overall US economy, because these are deals that have now become integral to the functioning of a business in globally anywhere. You talk about India, you talk about Europe, you talk about the US. So I think one part of the business probably will continue to chug along, and maybe we could see some bit of cutback on the other side of the business. Now, what remains to be seen is how much of your revenues are coming out of digital transformation deals. For example, in the case of Infosys, digital services almost provide for almost close to 50 or more than 50% of revenues. So I think that is what market will start differentiating on, that where are the big winners of the major, the bull market that people have been talking about since 2020, the digital or the cloud transformation bull market in the IT space. And I think one interesting bit, Santo, that I noticed really in the July data for mutual funds is that MFs actually were big buyers into the IT space. I mean, the entire low from about April to mid-July, mutual funds actually have been steadily accumulating IT shares. You talk about HCL Tech, you talk about TCS, you talk about Infosys, and even some of the mid-cap IT names have found favors with big mutual funds. So I think there is something to read there for those who are probably looking for bargains out there in the market. Well, with that, yeah, you had a point to say?
No, I don't.
Oh, great. With that, let's quickly now move on to the trade setup for today. And it is a muted start that the last street is looking at. If you look at the Nifty futures on the Singapore exchange, they're indicating about an 18-point cut on the index this morning. Now, this is on the back of a very very weak closing for Wall Street yesterday after the FOMC minutes came out. While, of course, the expectation of a 75 basis point rate hike at the next meeting has come off a little bit, but it clearly still remains one of the preferred bets of FOMC members. They have indicated that a lot needs to be done, but at the same time, they have also said that the Fed could risk going too aggressive on interest rates and end up hurting the economy in the long run. So clearly, Santo, I think even the Fed, now there is some doubt also, germinating within the Fed as well, and we will have to wait and see how the market takes this in the stride. Yesterday could be just part of the profit booking, given that Wall Street also has seen some of the biggest gains we have seen recently, but at this point of time the Indian markets still look quite healthy.
Well, no disputing that the mood is pretty much upbeat. If you speak to anybody, 8 out of 10 will say that the market is set to go higher, and if not higher, at least they don't see any big downside, which if you ask me sometimes is also a little worrying, because now the consensus seems to have shifted to the extreme other end. So, and many people are now saying that probably the market looks overbought at this point. Despite that, CJ, if I were to bet my money right now, I would say I would rather bet it on the market rising rather than falling.
Well, great, Santo. Good to have you on board, at least on that front.
I've changed my stripes.
Definitely. Now, let's move on to some of the other stocks that are on our radar, Santo.
Starting with CESC, steady performance. Now, the company's first quarter numbers fell short of analyst estimates. That was that was largely because it did not take the fuel cost adjustment, which usually power companies are allowed to take when it's when fuel costs are rising. Besides that, all its circles at this point in time are doing pretty well, except for the Malegaon circle, which is making losses. The other circles seem to be on a firm footing, especially the Dhariwal and Kota distribution franchisee, which are doing pretty strong. MK and Edelweiss are among the brokerages which are very bullish on the stock. Elara is also bullish on the stock. It has a price target of 110 rupees. MK has a price target of 105 rupees, and Edelweiss has a target of about 80 rupees for the stock.
Well, that indicates a quite decent upside. But I think for me, I think market is at this point of time probably likely to ignore such a low risk, low growth sort of a stock like CESC. At this point of time, it seems that the appetite, because risk appetite has come back quite strongly, market is looking for high beta, high growth stocks out there, and clearly you can see that in the rally that new age technology stocks are seeing at this point of time. So CESC, while Santo being a decent story, I just don't feel that the growth trajectory is that lucrative for a lot of the investors to come into the stock. And yes, Q1 earnings were quite decent, they were quite firm, and you talked about the concerns around Malegaon as well as the Haldia circle, which are the two which have offset some of the growth that we have seen in other circles. But overall, it doesn't inspire that much confidence that earnings going ahead will be so blockbuster that I should be probably betting my house on it. Well, next stock on my radar is Sona BLW. Sona BLW comstar, as is also known as. There is going to be the stock is going to be in focus today because there is a very big block deal expected on the counter. Blackstone, which is one of the promoters of the company, is expected to sell about 13.6% stake in the company through a block deal. Now, the deal will probably happen at a 7% discount to yesterday's closing price. But Santo, I feel that probably any sort of correction that comes in because of this mega deal could probably provide a decent entry point for investors. Why I say that is because generally Sona Comstar is probably one of the pure play EV plays in the auto ancillary space, not only because it has clientele back home in India, but it also has very good clientele outside in Europe and US. So clearly, if you're trying to play into the EV space, Sona BLW has been one of your go-to bets since the time the company got listed last year. And I think overall the growing share of EVs within the automobile sector, not only at home but globally, I think makes this a long-term story, and probably any sort of correction like this could be a good opportunity to bargain hunt.
Well, CJ, the stock has been underperforming for a while now, and if you see, the company was themselves mentioned that they're facing a bit of challenges at this point in time. There's a big bump up in earnings between 2019 and 2020, and since then the quarterly earnings have been pretty much in a steady range. And at this point, the big issue for Sona is that its European market, where it has fair bit of exposure to, that is facing some kind of a problem, which has said that besides two of its major clients have also kind of cut back. That's what the two big markets which account for a big chunk of the revenues also saw a major pressure during the first half. This clearly is an indication that maybe the market is sensing some bit of problems going ahead, which is why they don't seem to be in a big hurry to re-rate the stock. It had one round of re-rating, but after that things seem to have fallen.
And I think Santo, for a stock like Sona, I think that will generally be the course of life going ahead, because you've had a mega rally after the listing and then the stock cooled off quite considerably, and at this point of time you could expect some consolidation in the near term. But I think from a longer term trajectory, this is one stock, as and when the issues around the European market get sorted out, you would expect a good bump up in earnings, and that will start reflecting in the stock as well.
Well, last stock from my watch list is Kirloskar Oil Engines. Antique has initiated coverage on the stock with a price target of 295 rupees. According to Antique, the company is now trying to diversify beyond its standard diesel generating pumps. It is now getting into water management, bio waste management, induction pumps, and also firefighting pumps. Besides, with the government trying to improve availability of power for the farm sector, demand for electric pumps is also likely to go up. So quite a few things, few tongs in the fire for Kirloskar Oil Engines. Big volumes in the stock over the last few sessions. Definitely interest seem to be picking up, and Antique is of the view that the stock is relatively cheap when compared to its peers.
Well, Santo, I'll come back to you with my counterpoint, but let's quickly take a look at the market, and clearly it has been a negative opening. The Nifty is down about 0.3%, the Sensex same, down about 0.3%, but incidentally, the market breadth is still quite positive. You have almost 2 stocks rising on the NSE for every 1 stock that is declining.
And you have Nifty Bank also, which is down about 0.4% at this point in time. Sensex still holding on to the 60,000 mark, which is seen as a key level by most technical analysts.
I think, Santo, is the Nifty small cap probably which has made a better start than probably the other major indices. Nifty small cap is flat at this point of time, just turned into the green territory, and even Nifty mid cap is trying to make a comeback. So clearly that is explaining why you are seeing a more positive breath in the market, because the small caps are clearly faring better than the large caps out there. Well, Santo, coming back to Kirloskar oil, I think of course the overall performance in Q1 and of course the management commentary with respect to diversification is quite impressive. And even if you look at the balance sheet of the company, it has probably had one of the best balance sheets in the space that it functions. But I think growth itself is not that impressive, and I think that is somewhere where I think Kirloskar will probably miss out on a lot of inflows from investors compared to say another higher growing company out there. I think at this point of time, investors are not interested in safer bets, because I think that phase of the market, as you mentioned earlier, in your comments, that phase of the market has probably left us behind a month or two to go. So clearly, I think in that sense, it could suffer. And the other risk that is there is that the management has indicated that export is where they are very confident. They expect the Middle East market and the African market to generate good export orders for them. But the Middle East market could, of course, come under risk because crude oil prices now are on a declining trend. They have recently hit a 6-month low, and we know that generally Middle East economies tend to suffer when crude oil prices are on a lower trajectory. So clearly, I think those 2 points would probably make me a little skeptical as far as Kirloskar oil engines are concerned. My last stock for today is Kpit Technologies. Another, although it is an IT name, it is one of the stocks that is linked to the EV story, and the stock has seen quite a decent recovery from June lows. It has seen almost double-digit returns after the Q1 earnings came out to be quite impressive for the company. Now, the exposure that the company has to the EV space, because it provides a lot of software delivery to EV manufacturers across the world, that itself makes Kpit a very interesting bet to look out for. Now, Kpit believes that at this point of time, software costs as a part of the overall cost of manufacturing EV, Santo, is about 10 to 20%, right? The company believes that this could rise to about 30% in the near term, and in the long term, this could become almost 50%. That means that much more avenue for Kpit to generate revenues from its EV clients. So I think that way, if you look at Kpit, this is a very, very interesting growth story which is available at a reasonable valuation and probably could attract some of the longer term investors out there.
Well, just a couple of points here. Top line growth for the last many quarters have been steady at best, I would say, for Kpit, and in the June quarter both FIs and FPIs cut exposure to the stock. Well, with that, we have time for one viewer query, and Kushagra wants to know our thoughts on Coal India.
Well, Coal India, one of the best performing stocks this year in the Nifty. I mean, what do you say? I mean, if you look at the June quarter earnings, the numbers were just spectacular, and I think at this point of time, nobody would want to venture a bet against Coal India. Clearly, the company is benefiting from the lack of supply at this point of time in the domestic market, and even higher coal prices in the international market. The most important thing for Coal India at this point of time is the premium on the e-auctions that it does for the secondary sales, and there the premiums are running as high as 200%, Santo, at this point of time. So if you look at what analysts have to say, they believe that the rating the upgrade cycle to the earnings will likely continue at least for FY23, and therefore you could expect the stock to be among the outperformers in the rest of 2022 and maybe even in the early parts of 2023.
Well, CJ and I have been debating on the stock for a fair bit. CJ is the cheerleader for the stock. I'm not so positive, mainly because coal at the end of the day is still a sunset sector. It's doing well because coal prices are rising, but if you see over the last 8 or 10 years, the stock has been consistently underperforming. Once in a while when coal prices go up, the stock is back in demand. But given that the world as a whole is moving away from coal, the big gains in the stock clearly seem limited. It's a good dividend yield, but at the same time there's also the PSU tag, which means that the company is never going to make supernormal profits. It may be a good dividend deal. As I said, that's one way you could play the stock. A tactical bet, I would say, at best.
I think there are 2 points. Even though the world is trying to move away from coal, the ongoing energy crisis that we have seen, or that the world has created for itself with the Ukraine-Russia war, clearly will make economies reliant on coal at this point of time. I don't think in the short term they have any other option but to rely on coal. As sad as it is for climate change, that is the reality that we face. And lastly, I would want to wait for that 245 mark to cross and see how Coal India behaves, because that will be the IPO issue price of about 245 that the company had when the IPO came out in 2010.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. I hope you enjoyed watching it. Please do share your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a great trading session.